I have built three scenarios: optimistic case, base case, and the conservative case. I have projected revenues will grow at 20%. Intrinsic value per share for the Travel Food Services Limited is. Travel Food Services Limited, or TFS, is one of the top players in India's airport food and hospitality space. The company has established a strong presence across high-traffic travel locations by focusing on two key segments: quick service restaurants and airport lounges. The company has successfully captured the attention of millions of travelers by offering fast, convenient food options along with premium, comfortable lounge experiences. As of financial year 2025, the company holds around 25% of the revenue market share in India's airport quick service restaurant segment and about 45% in airport lounges, making it a clear leader in the space. TFS operates the largest travel-focused QSR and lounge network in India. It runs over 410 quick-service restaurant outlets, with nearly 380 of them located at airports and the rest on highways. In the lounge segment, the company manages 28 private lounges spread across 10 major airports in the country. These operations are backed by long-term concession agreements with an average tenure of about 8 years, won through competitive bidding processes. The company also boasts a highly diversified food and beverage brand portfolio. It operates leading international and regional names like KFC, Pizza Hut, Subway, and Third Wave Coffee. Alongside these, the company has built strong in-house brands such as Cappuccino, Curry Kitchen, and Dilly Street. As of FY 25, it runs around 90 licensed brands and 37 proprietary in-house brands, giving it both scale and flexibility in its offerings. The company continues to lead with traveler-focused innovations designed to enhance the passenger experience. From self-ordering kiosks and online food ordering to in-airport delivery and contactless payments, it has embraced technology to make service faster and more convenient. In its premium lounges, the company offers spa services, live music performances, and even dedicated zones for watching sports, turning transit time into a comfortable and enjoyable experience. It has also built strong strategic partnerships that support long-term growth. The company operates at Delhi Terminal 3 in collaboration with Delhi International Airport. It has joint ventures with GMR Airports for running outlets at Goa and Hyderabad, and also with Adani Airport Holdings and AJ Holding Limited, covering key airports like Mumbai, Ahmedabad, and Jaipur. These alliances ensure high visibility and presence at some of the busiest airports in the country. In FY 25, company generated a total revenue of approximately Rupee 1,688 crore. The largest contributor was the travel QSR segment, bringing in around Rupee 872 crore, which accounted for nearly 52% of the overall revenue. Lounge services followed closely, contributing about Rupee 758 crore, or around 45% of the total revenue. The remaining Rupee 57 crore, or 3%, came from management and other services. This shows that while both QSR and lounges are major pillars of the business, the QSR segment remains slightly ahead in revenue contribution. As of FY 24, there are 135 operational airports in the country. This number is projected to increase to between 165 and 185 airports by FY 29, and further to around 185 to 205 by FY 34. This steady growth reflects rising air travel demand and continued government focus on improving connectivity. For companies like TFS, which operate extensively within airports, this creates a massive opportunity to scale operations, enter new locations, and capture a larger share of the growing travel food and lounge services market. The India airport travel QSR market is poised for rapid growth in the coming years. In FY 25, the market size is estimated to be between Rupee 37 to Rupee 39 billion. This is expected to nearly double by FY 29, reaching around Rupee 70 to Rupee 80 billion, growing at a strong CAGR of 19.7%. The momentum is projected to continue beyond that, with the market size further expanding to Rupee 170 to Rupee 180 billion by FY 34. India, with a population of 1.4 billion, is witnessing strong and sustained consumption trends. Private consumption forms nearly 60% of the country's GDP, highlighting the growing spending power of its people. Within the airport ecosystem, travel QSRs and lounges play a major role, accounting for about 35% of the total airport retail market. This underscores the importance of food and hospitality services in shaping the overall travel experience and signals strong growth potential for companies operating in this space. The IPO for Travel Food Services Limited is scheduled to open on July 7, 2025, and will close on July 9, 2025. The issue is entirely an offer for sale with a total size of Rupee 2,000 crore. The price band has been set between Rupee 1,045 to Rupee 1,100 per share, and the lot size is 13 shares. The tentative allotment date is July 10, 2025, followed by the initiation of refunds on July 11, 2025. The company is expected to be listed on the stock exchanges on July 14, 2025. One of the key risks for company is its high dependence on concession agreements. The company operates through lease, license, and tenancy agreements with airport and highway authorities. This means its ability to expand or even maintain operations is directly linked to securing and renewing these agreements on favorable terms. If company fails to retain existing concessions or win new ones, it could face serious hurdles in its growth path. Another major risk lies in the reliance on brand partnerships. As of FY 25, nearly 54% of the company's travel QSR revenue comes from partnered brands. If TFS is unable to renew existing franchise agreements or attract new brand partners, it could significantly impact revenue streams and limit the company's ability to grow or diversify its offerings. Third key risk for TFS is the potential failure to maintain its lounge partnerships. The company's lounge business heavily depends on strong, long-term relationships with domestic and international airlines, card issuers, and payment networks. As of FY 25, lounge services contribute nearly 45% of total revenue. However, most of these agreements are short-term and renewed annually, making this revenue stream vulnerable to disruptions if partnerships are not renewed or discontinued. The fourth risk involves regulatory compliance, especially for the travel QSR segment. TFS operates in a highly regulated environment governed by the Food Safety and Standards Authority of India. Any failure to comply with these regulations or sudden changes in food safety laws could harm the company's reputation, result in penalties, and negatively impact operations and revenue. Company is actively working on multiple strategies to fuel its growth. First, it's optimizing its product offerings and services to boost like-for-like sales. By enhancing its menu, upgrading customer service, and introducing digital innovations, the company aims to increase repeat visits and improve sales across existing outlets. Second, TFS is expanding its network within existing markets. It's deepening its presence in high-performing airports and travel hubs by adding more QSRs and lounges. This not only helps capture more footfall, but also drives greater operational efficiency. Lastly, the company is building a strategic presence in newer markets, including global airports. TFS is targeting international travel hubs with high passenger volumes to replicate its successful India model on a global scale, tapping into new revenue streams and diversifying its footprint. Let's take a quick look at the performance of some of the top companies in the Indian QSR and food services space, focusing on their sales and EBITDA margins. Travel Food Services has reported sales of around Rs 1,688 crore with a strong EBITDA margin of 33%, which indicates a very efficient and profitable operation. Jubilant FoodWorks, known for operating Domino's, reported the highest sales among the listed players at Rs 8,142 crore. However, their EBITDA margin is lower at 19%, showing that despite strong revenue, profitability per rupee of sale is moderate. Devyani International, which runs brands like KFC and Pizza Hut, posted sales of around Rs 4,951 crore and an EBITDA margin of 16%. Sapphire Foods, another KFC and Pizza Hut operator, reported sales of approximately Rs 2,882 crore with a similar EBITDA margin of 17%. Westlife Foodworld, which operates McDonald's in western and southern India, had sales of around Rs 2,491 crore and an EBITDA margin of 13%. Restaurant Brands Asia, the operator of Burger King India, posted sales of about Rs 2,551 crore but with the lowest EBITDA margin of just 11%. In summary, Travel Food Services leads in profitability with the highest margin, while Jubilant leads in sales. The rest of the players follow with varying combinations of revenue and operational efficiency. Now we've come to the most important part, the intrinsic valuation of the company. To capture a full range of outcomes, I've built the model using 3 scenarios. In this optimistic case of the DCF valuation, I've assumed that the company will experience strong revenue growth of 25% annually over the next 10 years. This is a very bullish scenario where the business scales rapidly, backed by expansion, increased consumer demand, or market dominance. Starting from year 1, revenues are around Rs 2,203 crore, and they steadily grow each year to reach Rs 16,416 crore by year 10. In the terminal year, revenues are projected to touch Rs 17,237 crore. This consistent 25% growth highlights aggressive expansion assumptions. Now let's talk about the EBITDA margin. I've assumed a gradual decline from 33% to 30% over the forecast period. This slight drop reflects the idea that while the company grows in size, some operating efficiencies might get diluted or costs may slightly increase, maybe due to competitive pricing or higher input costs. Despite the margin softening a bit, EBITDA in absolute terms grows significantly due to the rising revenue base. For example, EBIT grows from Rs 588 crore in year 1 to over Rs 4,400 crore by year 10, and Rs 4,621 crore in the terminal year. The effective tax rate is assumed to be 25%, so after-tax EBIT, also known as NOPAT, adjusts accordingly. Depreciation and capital spending are added and subtracted respectively to arrive at free cash flow to the firm. Changes in working capital are also factored in. As a result, free cash flow increases dramatically from about Rs 583 crore in year 1 to over Rs 3,935 crore by year 10, with the terminal year seeing Rs 3,492 crore. Lastly, these future cash flows are discounted to present value, which gives us the intrinsic value contribution from each year. This present value starts at Rs 526 crore in year 1 and goes beyond Rs 1,388 crore by year 10. Let's look at what the numbers finally tell us about the value of the business. The present value of free cash flows during the high growth phase comes out to around Rs 8,373 crore. On top of that, we have the present value of the terminal value, which is around Rs 20,632 crore. When we add these up, we get the total value of the firm at approximately Rs 29,004 crore. From this total value, we subtract the market value of debt, which is around Rs 110 crore. That gives us a market value of equity of about Rs 28,894 crore. When we add the company's cash and cash equivalents, about Rs 25 crore, we arrive at a final equity value of roughly Rs 28,919 crore. Dividing this by the total number of outstanding shares, which is 13.1 crore, we get a fair value per share of approximately Rs 2,207. So, based on this optimistic scenario where the company grows revenue at 25% annually and maintains strong profitability, the fair value per share works out to be Rs 2,207. Let's see the base case scenario. I'm taking a more realistic and balanced approach compared to the optimistic case. I've assumed that the company's revenues will grow at a compounded average growth rate of 19% over the next 10 years. Additionally, I expect the EBITDA margin to gradually decline from 33% to 27% as the business matures. Starting with revenues of around 2,098 crore in year 1, they are projected to reach approximately 10,038 crore by year 10. While margins decline slightly, EBIT continues to grow steadily due to consistent revenue growth. After adjusting for taxes, I've added back non-cash charges like depreciation. Then I've subtracted capital spending and changes in working capital to arrive at the free cash flow to the firm. These free cash flows are discounted back to their present value using an appropriate discount rate. The present value of the free cash flows to the firm during the high growth phase is around Rupee 6,000 crore. In addition to that, the present value of the terminal value of the firm is approximately Rupee 10,520 crore. Adding both gives us the total value of the firm, which comes to about Rupee 16,530 crore. From this, we subtract the market value of the company's debt, which is Rupee 110 crore, to arrive at the market value of equity, which is around Rupee 16,420 crore. Now, if we include the company's cash and cash equivalents of Rupee 25 crore, the final value of equity becomes Rupee 16,445 crore. With a total of 13.1 crore outstanding shares, the value per share works out to roughly Rupee 1,255. Now let's see the conservative scenario. I've assumed that the company will grow at a rate of over 15% for the forecast period. However, I've also taken a cautious view on profitability. Specifically, I've estimated that the EBITDA margin, which is currently around 33%, will gradually decline to 25% over time. Let's look at the financial projections. Revenues are expected to grow from about Rupee 2,027 crore in year 1 to roughly Rupee 7,131 crore by year 10. Alongside this, COGS also rises, keeping in line with the reduced margin assumptions. Depreciation increases steadily each year, which is expected as the firm continues to invest in its assets. EBIT, or operating profit, grows from Rupee 530 crore in year 1 to about Rupee 1,446 crore by year 10. After accounting for taxes, the net operating profit after tax, or NOPAT, grows from Rupee 398 crore to about Rupee 1,085 crore. Adding back depreciation and adjusting for capital expenditures and changes in working capital, we get to the free cash flow to the firm, or FCFF, which grows from about Rupee 513 in the first year to nearly Rupee 1,495 by year 10. When we bring these future cash flows to present value terms, we get discounted cash flows ranging from Rupee 463 crore in year 1 to about Rupee 527 crore in year 10. These numbers form the basis for the overall valuation in this conservative case. The present value of the free cash flows to the firm during the high growth phase is approximately Rupee 4,847 crore. On top of that, the present value of the terminal value of the firm is around Rupee 6,352 crore. Adding these together, the total value of the firm comes to about Rupee 11,199 crore. From this, we subtract the market value of debt, which is Rupee 110 crore, to arrive at the market value of equity, which is roughly Rupee 11,089 crore. When we add cash and cash equivalents of Rupee 25 crore, the final equity value increases to approximately Rupee 11,114 crore. With 13.1 crore outstanding shares, this gives us a value per share of around Rupee 848. This video is for educational purposes only and does not constitute investment advice. I am not a Securities and Exchange Board of India registered advisor. Please consult your financial advisor before making any investment decisions.